So all businesses tend to have some amount of debt. Now, if you take a look at a typical balance sheet, this is what you see. You have assets on the left-hand side, and on the right-hand side, you have the sources of funds. This is where the money came from to fund these assets. Some is debt. It can be short-term, it can be long-term. It is debt nonetheless. And so as a financial manager, one of the questions that you need to be able to reflect on is, how indebted am I? Now, obviously, you don't want to be too indebted because that can be, well, it can cause financial distress. You don't want to have too little debt either, right? Because it turns out that debt can offer some tax advantages. We'll talk about it later. But before you can answer these questions, do I have too much debt? Do I have too little debt? You need to be able to assess how indebted you are. And that's exactly what long-term solvency ratios are trying to do. Now, you don't want to look at dollar figures. You don't want to say, oh, I have $5 million in debt or 50 million. That may sound like a lot, but it may not be because, well, what if you have $5 billion worth of assets? And so you always want to calculate ratios. One set of ratios that you can calculate is by looking at this balance sheet data. So, for example, you have a ratio called the total debt ratio. As the name suggests, it says, look, take a look at your total debt in relation to the total assets. So what percentage of your assets got funded with debt? That's really what it is. So take a look at debt in relation to the total assets, plain and simple. There's another ratio which does something very similar. That's the debt to equity ratio. It says that rather than looking at this debt in relation to the total assets, take a look at this debt in relation to the equity. Now, you can probably see this ratio is not going to tell you anything which is different from this. If your debt ratio is rising, right, because for a given amount of debt, let's suppose you have a lot of assets, or too few assets rather, right? Then for a given amount of debt, if the assets number is going down, this means that your debt ratio is rising. That's the same thing as saying that you have relatively less equity that is funding these assets, so your debt to equity ratio will be rising as well. So my point is that this ratio is not telling you something that is radically different from this, just doing it in a different way. There's another ratio which does something similar. That's called the equity multiplier. What this says is that, look, let's take a look at all of the assets and look at these in relation to the total equity. So do assets divided by equity. Now, you can probably see that since assets have to be equal to debt and equity, you're really just taking the sum of debt and equity and dividing by equity, which mathematically is the same thing as saying debt divided by equity plus equity divided by equity. I'm just breaking up this fraction, right? Decomposing it. Why? Because as you can see, equity cancels out with equity. So really all of this is really just saying, right, all of this is 1. Right? So you're really saying equity multiplier is 1 plus the debt to equity ratio. My point is that all of these ratios are basically trying to tell you the same thing in different ways. As you can see, if you have the debt to equity ratio, and if your debt to equity ratio is high, equity multiplier is going to be high as well, because it's going to be 1 plus exactly this number, right? You might ask, well, why are you doing this to me? Why are you telling me all these different ways of doing the same thing? Just calculate one ratio and be done with it, right? And, okay, you're right. But it turns out that sometimes in different contexts, these ratios will be helpful. For example, later on, you'll cover something called the DuPont identity. Don't want to go there. But over there, it usually helps to express indebtedness in a different way, specifically using the equity multiplier rather than the debt to equity. So these ratios do have different uses in different places. But look, at the end of the day, they're all trying to tell you the same thing, how indebted you are. So this is the total level of indebtedness. So let's take a stylized company. Let's suppose that you have a company called Coffee Froth Corporation. You have assets on the left side, short-term, long-term. Liabilities, short-term, so current liabilities, and long-term. So this is the total amount of debt. And then you have all of this, which is equity. So if you have these data, and let's suppose we're focusing on 2020, then if I'm going to erase all of this. So let's suppose you wanted to calculate the total debt ratio for this company. Then you'll say, okay, the total debt in 2020 is short-term, which is 540, and long-term, so 540 plus 457. So 540 plus 457. And I'm going to divide that by the total amount of assets, the total amount of assets right here, which is 3588. So 3588. If you do this math, you'll find, I'm kind of running out of space on this one, I'll find that this is 0.28. So you can either write this as 28%, or you can say 0.28 times, meaning that for every $1 that you have in assets, you have about 28 cents or 0.28 times that in debt, total debt, both short-term and long-term. Okay, so that's what this is saying. Is that good? Is that bad? Well, you can't really reflect on that unless you do either some sort of a trend analysis in which you're comparing this number to what it was in, say, 2019, 18, and so on, or you do a peer analysis where you say, what does this number look like for other firms in the same industry, right? So we've talked about this in previous videos, and I'm going to say it again. These ratios by themselves don't really mean much unless you are benchmarking them, either against yourself at different points or against your peers. If you had to calculate the debt to equity ratio, then how might you go about that? Well, debt is the same. You have 540 plus 457. But now instead of dividing it by assets, you would divide it by the total amount of equity, which for 2020 is 2591. So 2591. If you do this math, you should arrive at 0.38. And again, you can express this as times, meaning that for every $1 of equity that is going into the business, 0.38 times that is going in the form of debt. Equity multiplier, well, we just showed that it is 1 plus the debt to equity ratio. So really, just by looking at this number, you can say that it's 1.38, 1.38 times. Again, times, meaning that for every $1 that is going in the form of equity, there's 1.38 times that in assets. How is that possible? The only way that's right. So how is it possible that shareholders are only putting in $1 of equity, but it's translating into $1.38 worth of assets? The only way that's possible if the remainder 38 cents, the extra 38 cents, is coming in the form of debt. So this is what the equity multiplier is trying to give us. As you can see, this number will always be at least 1. It will be 1 if there is no debt. If you have 0 debt, then 1 plus the debt to equity ratio will have this guy basically equal to 0, in which case all the assets will be exactly equal to equity, right? So this would be 0. Assets will be equal to equity. So the equity multiplier will be exactly 1. And for any non-zero level of debt, this number will be, well, higher. And that extra amount will be reflecting precisely the amount of debt that is coming in. Right? So as you can see, all of these are different ways of measuring indebtedness. Now, there are a couple of things that I want to tell you when you're calculating ratios from the balance sheet using these data. The first is this. This is very important. If you know one of these ratios, you can calculate all of them. Let me illustrate using an example. Let's suppose that I calculated the total debt ratio for a company as 0.28, right? So you know that the debt ratio is 0.28 times, right? I gave you none of these data, let's suppose. All I told you was that, hey, there's a company, it's got a total debt ratio of 0.28 times, okay? You can just use this piece of information and calculate the debt to equity ratio and the equity multiplier. How's that? All that you need to recognize is that this, along with the balance sheet identity, can give you all the information. So write down the balance sheet identity. Whenever you write down one ratio, write down the balance sheet identity. Assets equal to debt plus equity. Do that. Now, when you say debt to asset ratio or debt ratio is 0.28, what does that mean? That means you're writing 0.28 over 1. Yeah, it's the same thing. Which basically is saying that for every $1 in assets, you have 0.28 in the form of debt, right? 0.28 to 1. If this equation needs to hold, what must equity be? Equity needs to be 0.72 so that it adds up to 1. Now you have all the ingredients to calculate all the other ratios. For example, the debt to equity ratio, Well, you know it's 0.28 divided by 0.72, so that's 0.28 divided by 0.72, which if you do the math, I'll leave it to you to show that's 0.38 times, and the assets to equity or the equity multiplier is going to be, well, you can do that as well. It will be 1 divided by 0.72, which you can again show is the same as writing 1 plus the debt to equity ratio. You can solve this, you'll find that this will come out to 1.38 times as well. So my point is, whenever you have one ratio, do the following. Write down the balance sheet identity and use that ratio to fill in 2 of the values. That will help you determine the third. And once you have the third, you have all the balance sheet ingredients to calculate everything else, right? If you know one, you know them all. That's one thing. Here's the second thing. This is very, 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 very important, okay? It is tempting to calculate indebtedness using balance sheet data, but remember that before you make any meaningful conclusions from that, remember that balance sheet shows you book values, not market values. And these are far more important. Okay, let me illustrate my point using an example. Okay, let's suppose that you bought an asset. Let's suppose that was a house, and the cost of the house was 500,000. Okay, so that's the asset. You funded it with debt. Debt was maybe 250,000, and the remainder was equity. So 250,000. Okay, so bought an asset worth 500,000, half debt, half equity. You can see that. All right. If I asked you what is your indebtedness or your total debt ratio, you might say, let me use a different color. Debt ratio, debt to asset ratio would be 250,000 divided by 500,000. So you can see that's 50%, right? Okay. Now let's suppose a year later that your house in the market for some reason became worth $1 million, right? 100% increase. Okay. What does that mean? You still have, on the books, you still have $250,000 worth of debt. But because the house that you own is now worth 1 million, basically your equity is now worth way more. It's worth $750,000, right? In market value terms, your balance sheet is also balancing, but the difference is that now your equity is worth way more. If somebody asks you how indebted you are in market value terms now, right, you'll say, I owe 250,000 on a house that is worth 1 million in the market. That's only 25% indebtedness compared to the 50%. On the books, you're still 50% indebted. This is my point, right? The balance sheet only shows you indebtedness on books, you know, what happened historically. Do you care more about that or the 25% now? You care about the 25%, the market value. Even the bank will care more about that when you go and try to get another loan, because they'll be like, okay, yeah, we can see that your house is worth way more. We are more willing to now lend you even more money, right? So my point is, don't jump to conclusions just by looking at indebtedness using balance sheet data. Market values are important as well. That information is not on the balance sheet. You do need to get or determine the market value of your assets. Okay, so bear that in mind. Now, that said, all these ratios that we calculated were using balance sheet data. There's another set of ratios which says, look, how does that matter? I could have a whole lot of debt. I could be 50% indebted, 80% indebted, okay, on the books or on the balance sheet. But what if I'm making enough money to cover all the interest payments that are due on those loans, on those debts? In other words, the way I want to measure my indebtedness or assess my indebtedness is not by how much debt I have, but by ability to pay it off. And that's the logic behind these ratios called coverage ratios. So for example, one ratio that you'll see is called times interest earned. Times interest earned basically says that, look, let's take a look at our earnings before interest and taxes, and then see how much that is in relation to the interest expense. The logic being that it is out of this amount that we're going to pay our interest. So the question is, how much are we making right before we have to make our interest payment, and see how much this ratio is. Now, as you can probably imagine, you'll ideally want this number to be at least 1, right? You want to have, for every $1 that you owe in interest, you want to have at least 1 to cover those interest payments. So for this stylized income statement, this would be something like 600 divided by 141, which, if you do the math, gives you 4.26. And again, the unit of measurement here will be times, which basically means that for every $1 that you owe in interest expense, you have 4.26 times that to cover that interest expense. Is this good? Is this bad? Well, again, you want to do some sort of a trend analysis. If over time this number has been consistently falling, then even though this number might be greater than 1 and therefore comforting, the trend is downwards, which might then cause you to go back and see, like, what's going on, or is this a good trend that I am on right now? Okay. There is another ratio which tries to do something similar. It's called the cash coverage ratio. The only thing that changes is that instead of EBIT, you look at EBITDA. What's the rationale? Basically, cash coverage ratio goes to times interest earned ratio and says, hey, wait a minute, buddy, this 276 million that you deducted in the form of depreciation, right, to arrive at this 600, technically this is a non-cash expense. This money never actually left. So really, if I were to ask you how much cash you have to meet your interest obligations, then technically that number will be a little bit higher. How much higher? Actually 276 million higher. So basically, do the same math, start with 600, but then add back the 276 to get the EBITDA. EBIT before depreciation and amortization, and then look at that in relation to your interest expense of 141. As you can imagine, this number will be higher than this. In fact, if you do the math, this will give you 6.21 times. So here's the difference. Notice that these ratios assess indebtedness using purely income statement data. And the previous set of ratios that I showed you, like these ones, these were using only balance sheet data. There are two different ways of reflecting on indebtedness. Okay. Now, there is a ratio that is often not talked about too much, but it's important, and I think you should know about it. It's called the debt-to-EBITDA multiple. Debt-to-EBITDA multiple. Notice the first thing about it. It's using some information from the balance sheet. Debt is coming from the balance sheet, and the EBITDA is coming from the income statement, right? So this is unlike the other ratios where it was either coming from the balance sheet or only coming from the income statement, right? This is a hybrid. This is a hybrid ratio. It looks at how much debt you have in relation to your earning power. Credit rating agencies use this a lot. If you've ever had the experience of going out there and buying a house, one of the things that they'll ask you is, how much do you earn? Because that is one of the factors that goes into how much debt that they're going to give you, right? If you earn like 100,000, they might say, okay, the maximum, all else equal, the maximum amount of debt that we'll give you is maybe 3 times that to buy a house or something, right? In the private equity industry, this is also a very, very important ratio. So these are firms so let's suppose that you're a firm which is going out there to maybe acquire another firm, and you need debt for that. You'll go to an investment bank, and the investment bank will say, hey, this firm that you're about to acquire, how much does it earn? What is its EBITDA? We'll take a look at that, and then the amount of debt that we will extend to you, which will be a function or a multiple of that, because this sort of gives us an idea as to how much this firm's ability will be to service that debt, right? So debt to EBITDA multiple. Very important, and again, in the context of our stylized company, the total debt we calculated for 2020 was 540 plus 457. And the EBITDA number we just showed was, well, the 600 plus the 276. So if you do this math, you can again calculate this. So this will give you 1.1 0.13, and again you measure this as times. So basically, for every $1 in EBITDA that this firm is earning, it has debt which is 1.13 times that. The greater this number, of course, the more indebted you are. Again, whether this number is good or bad, you need to do trend or cross-sectional analysis. Very important number. You should calculate this at the very least. A very interesting news article that came out in the Wall Street Journal recently was this, where it shows that credit rating agencies over time have become a little bit lenient in giving sort of high credit ratings to these firms. So this article, very interesting article, here's the link. It says bond rating firms go easy on some heavily indebted companies. What is this article showing? It's showing that as you're going from 2009 to 2019, credit rating agencies would calculate debt as a multiple of earnings. So basically do something like debt to EBITDA. And then investment grade rating used to be for firms which had rather low levels of this multiple, like around somewhere between 2 and 2.5. Some of the more junk rated bonds or not investment grade bonds, these numbers would tended to be higher, like around like a little below 2.5, right? And so these were basically firms that had relatively high amount of debt. What this is showing is that over time, investment grade rating has been given to firms even though their debt to EBITDA multiples have climbed up to levels as high as 3.0. Again, this is an interesting article. I'd urge you to actually read it, but my point was this: credit rating agencies use debt as a multiple of earnings or something like debt to EBITDA multiples in assigning their credit ratings, and that was kind of the point. This is a useful multiple for you to know to assess how indebted a company is. So this is how you can assess long-term solvency of companies. In future videos, we'll talk about some other ratios which help us reflect on other aspects of businesses.